Hi everyone, I'm Miles. Welcome to Erlang Insights. Here, we think through every idea before making a decision. Just a quick disclaimer, this show is for research and discussion only, not investment advice. If you want to think like a pro fund analyst, don't ask how much a stock can make. Ask, how much could I lose? How much could I gain? And is the potential return worth the risk? Say PEP is at 139.02. After some research, we expect it to swing between 120 and 170 over the next 6 months. To keep it simple, let's assume the price follows a uniform distribution between those 2 points and look at going long on PEP. First, the downside. If PEP hits 120, the loss per share is $19.02. Now the upside, if PEP hits 170, the gain per share is $30.98. So the risk-reward ratio is 19.02 divided by 30.98, which is 0.61. To put it more simply, reward over risk is 30.98 divided by 19.02, which is 1.63. So for every dollar at risk, we get 1.63 in return. That's below the 2-to-1 benchmark we use for initial screening. Of course, 2-to-1 isn't a hard rule for every hedge fund. Real standards depend on win rates, volatility, catalysts, liquidity, and worst-case scenarios. Going deeper, assuming the uniform distribution, the odds of PEP ending above 139.02 is 170 minus 139.02 divided by 170 minus 120, or 61.96%. That leaves a 38.04% chance of a drop. Under a uniform distribution, the expected value is the midpoint, 145. So the expected gain is $5.98, a 4.3% return. We can also calculate the expected value, 61.96% times 30.98 minus 38.04% times 19.02, which is $5.98. So under these assumptions, PEP has a positive expected return. But would a pro fund manager buy in immediately? Of course not. The real questions start now. Is 120 really a solid floor for the downside? What catalyst could actually push PEP to 170? Is a uniform distribution even realistic? What's the worst case if we're wrong? More importantly, are there other opportunities with higher expected returns? This is why risk-reward analysis is so vital for professional investing. You're not just guessing if a stock goes up or down. You're learning capital allocation under uncertainty. After all, great investing isn't just about finding upside. It's about understanding downside, estimating probabilities, calculating expected returns, and deciding if the reward is truly worth the risk.